Welcome to Cup of Joe. I'm Mike Carrazzo, joined always by Nick Webb. Nick, Happy New Year.
Happy New Year, Mike. How you doing today?
I'm doing good. Ready for another great year here on Cup of Joe. For those of you who it's their first time joining, welcome. We do this first Thursday of every month. It's a look into what's driving the economy, what's driving the commodities, with a little bit of live Q&A along the way. For those of you who's joined us in the past, welcome back for another exciting year. Like I said, you're going to see a button at the bottom of your screen for Q&A. So send us some questions along the way. We're going to be happy to answer them. And little bit of housekeeping before we get into this. So this coming right here in the first Thursday here after the new year. Quick turnaround after the new year here, but some exciting stuff. We're actually going to be hosting our third annual virtual conference Engage on January 26th. A little fun fact, like I mentioned in the past, Cup of Joe, for all intents and purposes, started the first Engage. Nick, you gave your commodities update, and everyone loved it. So we decided, heck, let's not do this. Let's do this monthly. So that's where kind of Cup of Joe's come from. So we're having our third annual one on the 26th. Registration's now open. You'll see on your screen, engage.tv. Actually, that registration should be www. Actually, no www. Just engage.tv. Registration. We're going to have Alan Bolio, as in years past. He gives a great economic update on what's moving the marketplace. We're going to have this live Cup of Joe with myself and Nick. We're going to have three special guests joining us, some product managers to go into what's moving stainless, carbon, aluminum, and a special guest. It may or may not be on a topic we covered in the past year. I don't know how much I can reveal at this point, but once that special guest is revealed, watch our social media. We'll have an announcement soon. But important note on that, since we're having it on January 26th, there will be no Cup of Joe on February 4th. So Nick will give his cell phone number. Everybody can just call him on the first Thursday of February to get their update. Kidding, of course. We'll resume back in March, which then we'll hopefully have our theme music back. And but yes, please join us on Engage. It should be an exciting event. Nick, anything you want to add to that?
No, it's just amazing that it's been 3 years. Time flies when you're having fun.
Yeah, it's been wild. It's been good, and I think a lot of stuff covered here, and I think we're in for another exciting year ahead, right?
Certainly seems that way, and hopefully we dive into some of that detail here on this Cup of Joe. But I will admit, I did hold out some of the charts, some of the data, as a little bit of a carrot to try and dangle for what we're expecting, or what I think we may see in 2023, which could be kind of wild. But with that being said, I'm going to go ahead and kick into my portion of this. As always, we have to cover our safe harbor provision, which is, this is the opinion of Nick Webb, Mike Carrazzo. These are not the opinions or investment advice coming from Ryerson. Do your own research, but we're putting together a lot of good information, or what we think is good information, that hopefully you can use to budget and plan for 2023 and the years ahead. But let's go ahead and get right into it. I was told I shouldn't focus too much on the years past, because we did a little bit of that in the December Cup of Joe, but we didn't have the full complete year in last month's data. So this is not really metals related, although it's somewhat tangentially related to metals and the markets broadly. This chart kind of astounded me a little bit. What this is showing is ultimately year over year, so beginning of the year to the end of the year, how markets performed across a combination of two things. One, equity markets, so the S&P 500, and then the other being the bond markets. For those who follow markets, invest, do anything like that, some investment advisors follow a strategy. It's called a 60-40 portfolio, which says maybe you should diversify a little bit, put some portion of your assets into stocks, put some portion of your assets into bonds. And the idea is they should counteract one another, that oftentimes when stocks are doing really well, bonds aren't doing so great. And then the reverse is also true. When things get a little rocky, things get a little soft, typically bonds are your safe income, annuity type investment. What's interesting about 2022 is it was a very tough year in both of those spaces. We had a scenario whereby both the equity markets as well as the bond markets took it on the chin. And when we look all the way back to 1950, it was the third worst market in terms of performance of that 60-40 portfolio, which is 60% weighting in stocks, 40% weighting in bonds. Long story short, if you felt a little bit of pain last year, you're not alone. There's a chance we may see a little bit of that continuing, and we'll get into some slides that may support that or counteract that. But I think an interesting context to kind of end 2022 and start off 2023.
Nick, is that -3 there? Sorry to go back. Is that 2018 roundabouts?
Yeah, that would have been, let's see, 2020. Yep, that would have been 2018.
A little bit dip in the market there, yeah. But wow, that's so yeah. The green is equity return and fixed income return. So that's the lowest we've seen, right? Since well, no, I'm sorry, from 08. Yeah, a lot.
Yeah, since basically the great financial crisis. Yeah,
wow.
So it's, it puts it into context, and a little bit of this is cherry picking because it's only looking at January through December. Obviously, when we had the COVID lockdowns, things got really, really bad very quickly. Yep. But they also improved relatively quickly coming out of that. So, using year end date versus year beginning date, you don't really get to see that in this context, but, just a different way of looking at it. Now, similarly, we just got the ISM manufacturing data yesterday, and unfortunately, the overarching theme is contraction for now. When we look down at the very bottom, you get the summary item, which is basically saying for the last month or two, we have gone into contractionary territory from the U.S. manufacturing side of things. So I think we've seen this coming for a few months. I've been talking about some of my Dr. Doom or bearishness aspects to the economy, which does seem to be hitting some headwinds. A couple positives that I pull out of this, though, the unemployment side of things is actually improving incrementally. And some of that makes sense because as you have markets weakening, the ability to hire people, getting people to come off the sidelines, that does get easier. So that's one positive that unfortunately comes out of a negative aspect of the economy. But then the other one is prices, which, if we look across the price of most commodities right now, whether it's oil, natural gas, aluminum, nickel to a degree, steel certainly, prices are much lower for manufactured goods in most instances right now relative to where we'd be in prior months and prior quarters and even a year ago. So a little bit of good news within that for our consumers out there. It does look like the employment picture is getting incrementally better. Prices are certainly, they've been beaten up over the last 9 to 12 months, I'd say. But unfortunately, that does come at the expense of what looks like a softening macroeconomic or manufacturing environment. And corroborating that is, so the last slide was showing ISM data. This is showing the market data, but both of them are doing the same thing, which is taking a survey of purchasing managers. Not a real big change on a month-over-month basis, but again, just looking left to right, you can pretty easily see from a visual standpoint, we've gone from a very strong start in 2022 to ending 2022 with, I would say, most regions of the world in sub 50 territory, which is year-over-year weakness in the manufacturing sector. Again, the bright spots, interestingly enough, appear to be India, which is running extremely hot right now. Russia is having 2 months of relative strength, which is a bit of a surprise. I was kind of thinking that might have been just a one-off, 1 month thing. That's continued into the month of December for now. And then the other one that's turned into a bright spot on a relative basis is Mexico. So for any of our customers or any of our salespeople who have exposure down into the Mexican territory, it does look like that market is perking up a little bit. But unfortunately, most of the other developed markets, whether you're looking at Asian nations, Europe, or the United States, do look like they're in cooling mode for now.
Hey, Nick, for Mexico, that's a big jump if you look from last year, right? 46.1 now to 51.3. Do you think any of that speaks to the nearshoring trend? Some business, some operations moving closer?
Yeah, I think a portion of that can be nearshoring. Just countries trying to find the cheapest, safest combination of places to put assets and production. I think another combination of that could be coming from automotive. That as automotive is beginning to get more availability of chips, there's a lot of automotive assets that are down in Mexico as well that could be helping to lift that up as well.
Yeah, interesting.
Now on the bright side, which is interesting, and this is a little bit of a good news, bad news thing, and I'll explain what I mean by this. But when we look at the services economy, so we think about things like real estate or hospitality, leisure, travel, things like that. That side of the economy is still running quite hot. Now, I do have to admit, this data will not be updated for December until tomorrow morning on Friday. So this is still running off of November data, but my guess is it's not going to be too much different as we fast forward to December data. But we'll touch on that in our engage when we circle back up here in a couple of weeks. But you look down here at the very bottom, the overall summary for the services economy. It's growing, and it's growing faster than it was a year ago. So, is it running on fumes? I don't know, but for now, that side of the economy is still running quite hot. Now, the reason why I say that could be viewed as bad news is because, as we've talked about in prior Cup of Joes, the Federal Reserve is very much so trying to make an effort to cool off really all aspects of the economy. And, we're seeing it hit within the goods side of commodity inflation. But we're not yet seeing that hit within the services side of the equation. The other place where we're not seeing it hit is in the jobs side of the equation. We've talked about this in prior months, but what this chart is looking at is two things, and we've got one new data point on here. They're basically the same chart, basically saying the same thing, but the white line is going to be the number of job openings that are currently available. And you can see on a 22-year history, it's come off from its peak from 12 million people down to 10.4. But it's remaining stubbornly high, despite the fact that we have, massive rate increases of 400 to 500 basis points. We have a Fed that's literally trying to cool down the employment picture, trying to cool down wage growth. But despite all those facts, we still see job openings remain at very, very robust levels. Similarly, what we're looking at here is what's called the quit rate. And it's put together by the same entity, which is the JOLTS entity. And what this ultimately looks at is the percentage of people that are leaving their job to go to another job of employment. And the reason why this is interesting is, in this environment, you would think that people would be a little spooked that things are softening, they're a little scared to make the move to another job. Well, if we look at this historical basis over the 22-year period, again, yeah, we've come off the absolute highs of people being willing and able to quit, but we're still extremely high, which means that the labor force is still feeling quite confident that they can go out and not just find another job, but in all likelihood, probably find another job at a bigger increase than what they could get by staying at their existing employer. So this is not advice to go, leave your employers and bail on Ryerson or bail on your manufacturing company. But this is certainly a phenomenon that is going in the face of what we're seeing in some other aspects of the economy, which is the jobs market is just quite strong and quite resilient for now.
Nick, I don't mean to put you out on a limb if you want, but what, we've seen this for a few months now, manufacturing contracting, slowing down, if you will, but employment really staying strong. I mean, what do you take away from that? Why is that? Why does that remain that way? What could that possibly mean going forward?
Yeah, I mean, pretty loaded question, and I'm not going to be the perfect guy to answer that. But I mean, admittedly, over the last 24 months, there's been a ton of money that's been put into the economy, and a lot of these, companies that are able to employ people, they've made a lot of money over this time as well. And to the extent they're able to spend, they may be doing that on increased wage growth for employees. I think a lot of this is coming from the idea that there's still a large percentage of the workforce that's sitting on the sidelines. And so as they sit on the sidelines, that keeps job openings high. That keeps the desire to pay people who are willing to come off the sidelines. That increases that need as well, or that piece of the equation as well. But that can change. I mean, and I think that is truly the goal of the Fed, is to create that change, because otherwise we do run into this situation. And this is a little perverse, where as wages keep going up and up and up, and right now I think the wage growth number is right around 6%. That's a pretty big number. That becomes sticky. Wages, unlike commodities, tend to be a little more, once they get up there, usually people aren't willing to take pay cuts. Unlike the price of steel, which can, we saw it go to $2,000, come back down to $650. Wages don't tend to do that. So that becomes a thorn in the side of the Fed, who's trying to fight inflation, which, again, I know that sounds weird, that the Fed wouldn't want people to make more and more money. But that is the weird fight that they're fighting right now, because that would feed through to the more people are getting paid, the more they can spend on goods and services, the more you get inflation being persistent, and then, the cycle continues.
Yeah, what I love about the Cup of Joe audience is they're chiming in with their own thoughts. One gentleman from the RV industry says they're definitely seeing that instead of laying off, working 3 days a week or shutting down 1 week per month, et cetera. So yeah, and then just to confirm, the white line is the quit rate, or is that the?
I apologize. White line is going to be on the left axis, so that's going to be the 10.4 million. So that's in thousands, 10.4 million people. The quit rate is going to be 2.7%.
Got it. Great.
And yeah, to feed on that anecdote, one other one that I had heard was the trucking industry. A lot of truck drivers are opting to not necessarily, this is a bit of a caveat on the whole thing, they're opting not necessarily to take more money. What they're rather doing is trying to renegotiate to work less days or fewer hours and keep the same wage that they were having before. So, kind of the same story, which is the workforce does have some leverage here in this environment still right now.
Yeah, very interesting.
Now, a little bit of a new piece of news is energy prices, at least or particularly in Europe, are correcting fairly rapidly. Now, they are, admittedly, as we look back to March of 2021, they're still at extremely elevated levels. And this is looking at natural gas in US dollars per MMBTU. That's going to be in the blue line. The white line is going to be the United States. So you can still see there's a massive gap where they're paying 6 or 7 times what we are here in the United States. But prices have dropped from about $90 per MMBTU in Europe down to 20 in a fairly quick fashion. I mean, you're talking about 3.5 months where this has occurred. Now, what's going on? I promised Mike I was going to put on my meteorologist hat today. This might be a little bit of a busy chart or difficult to understand, but I'll try and run through it real quick. The white line is ultimately going to be your 30-year average of Western European temperatures. And unfortunately, I couldn't figure out a way to translate it into Fahrenheit. So we have to deal with the European metric system or Celsius system. So the average, as you can see, for this time period is somewhere right around 4 degrees Celsius. The yellow line is what we saw, what we experienced over the mid to late December and early January time period. One of Mike's colleagues in our marketing team, he was actually over in Europe just in the last week or two. And from what I understand, they were basically having spring-like temperatures in the middle of winter. Now, we talked about this 6-8 months ago. As we were discussing this potential looming energy crisis as we were coming into winter, the one caveat to that entire energy crisis thesis was, if we have a warmer winter, this might not be an issue. And up to this point, knock on wood, this has not been an issue because we have much warmer temperatures. And to put it into context, it's about 10 to 15 degrees above the prevailing 30-year average. So that's a meaningful move, and that does allow the country to build stockpiles of natural gas liquids, crude oil, things like that. Now, the one caveat to all of that is as we look forward, and again, I am not a weatherman, I don't know how this forecast is made, but it is suggesting that this will not be long-lived, these warmer temperatures, rather. And as we look forward to mid-January, it is expected that we get back down into more normalized type temperatures. But there is the good news of perhaps the country, the continent has built up reserves enough that they can make it through this without too crazy of prices.
What's the gap there, Nick, between December 31st and like January 7th?
Right here in the middle of the chart?
Yep.
I have no idea. All I can suspect is the model does like some sort of lead look into the future.
Gotcha. Okay. Yeah.
But you're going beyond my meteorology skills already, Mike.
Well, it looks like you're predicting very cold weather around the January 15th.
Sure. Yeah. And I have no idea why that would be. Now, we've talked about this briefly already in this Cup of Joe, but we do obviously at this stage have a very aggressive Fed. We have an aggressive Fed from the standpoint of they're hiking interest rates at a faster rate than really we've seen, at least in the last 20 or 30 years, probably going all the way back to the late 70s, early 80s. What we also have is a Federal Reserve and all of the Federal Reserve presidents around the country who are really doing their effort to jawbone a very hawkish stance, or the stance that they really want to cool off markets. So those are really two of the big tools that they have to kind of spook markets and get people to spend less and hopefully bring down inflation. The other tool, obviously, that they have is to reduce the balance sheet of the Federal Reserve. So, they are really using all those tools and levers. What's interesting about this chart, and I think I touched on this last month, is the idea that when we look at the Fed funds rate, which is going to be shown in the white line, they've basically converged. It's at 4.5%. We've got the 2-year Treasury yield at 4.44. So we have this phenomenon now where the 2-year Treasury market, which for all intents and purposes is the market's best guess of where interest rates will be in 2 years from now, it's currently at a discount to where the Fed funds rate is. What's that mean? What that basically means is there are people in the market who think that between now and 2 years from now, the Fed is not just going to have to slow or stop hiking interest rates. They may even have to bring interest rates back down. Now, why would they have to do that? This is the good news, bad news thing, which is if the Fed is decreasing interest rates, it's probably because they're beginning to see things break, or the optimistic side is they are rapidly seeing inflation come down. Now, my personal belief is if inflation is coming down at a very, very rapid clip and they actually have to decrease rates, then that probably means we're starting to hit a little bit of a panic button, and they're trying to actually stimulate the economy rather than cool it off, which is the stance they're in right now. And last but certainly not least, I was a little premature in this over 2022 in talking about China and their moving away from zero COVID policy. It's looking over the last 2-3 weeks as if they are very rapidly going towards the removal of zero COVID policies. So much so that actually other nations around the world are beginning to put up their own blockades to say, we need to test these people. We need to put up restrictions to disallow some of these people who may be testing positive when they arrive in all these countries. So it's a little interesting how the tables have almost flip-flopped at this stage. But make no mistake about it, it does look like both verbally and from a mobility standpoint, China is getting back towards normal. Now, I personally don't think it's going to be something that happens overnight. I don't think it's going to be something that happens over the next 2-3 weeks. But I think as we roll through first half of 2023, rather, I do think that, they're going to continue to have, local spread of the virus. They're going to have to come to grips with this potentially becoming a way of life, a more normal approach to the world. And the one thing I will say, when we look at this data, I put these up here just for context more than anything. I don't think the reporting of the Chinese COVID data is anywhere near accurate anymore. And I feel confident enough to say this now, because if we look over here on the right-hand side, the total cases in a country of 1.5 to 2 billion people, they're basically saying that since the inception of COVID, they're saying only 4.6 million people have gotten COVID. I've seen some estimates that are suggesting that up to 800 million people have already been exposed. So, there might be a lot of gap in whose forecast is right or what's the accurate number, but I'm pretty darn confident that as they get back to normal, they're going to have way, way more than just a couple million cases. They're going to have hundreds of millions, if not into the billions of cases at some point in the next year or two. But what this means for commodities is the sleeping giant has awoken. And that's not to say that commodity prices have to rip higher, because we obviously have touched on the fact that Europe, many other developed economies, the United States, North America, they're kind of going the opposite direction with regards to the manufacturing environment. So there is a bit of a push-pull taking place. But as we look forward to 2023, and this will be a little bit of a theme as we get into Engage and we start talking about themes for 2023, China's got to be a big one. It's got to be one that we're discussing. It's got to be one that we're considering, because as we've talked about in the past, China is 50 to 60% of most commodities demand and production. So when they come back alive, we should certainly pay attention, because they could be a needle mover in a lot of different commodities. And we'll touch on a couple of those here in a few slides.
Hey Nick, what was the PMI number currently for China from your chart? Kind of
I'll pull up the exact number for you. So it was just south of 50 as of December. So okay. This is going to be something we want to watch for sure. If we start to see that, if we start to see headlines suggesting that China is lowering interest rates or putting, additional loans into the economy, doing things to stimulate the housing market, those could be the efforts or the headline type factors we want to keep an eye on that could suggest that come January data, February data, or maybe sometime in first half, we begin to see those PMI numbers tick back above 50. And if and when that happens, I think you could start to see China take the lead or take the reins on what ultimately happens within the commodities markets.
And we got a question here from the audience related to that. Do you think reshoring or nearshoring is essentially forcing their hand on COVID policies?
I do think economic factors are forcing their hand to a degree. I mean, I think, and we've talked about this probably for the better part of a year now, Chinese infrastructure markets are extremely weak. They've certainly got their own debt issues that they're dealing with. And the longer they stay locked down or in some semblance of a zero COVID policy, the more difficult it gets to get out of that. Whether or not that's specifically related to nearshoring and companies threatening to pull things out, I don't know for sure. It's certainly part of it, but I would say it's more of a generalized economic reaction. And I think there's also a humanitarian aspect to it that, you know, at some point after 2.5, 3 years, you've got to have your citizens getting back. Otherwise, you run the risk of having some sort of revolt or something like that. But with that said, it's great timing on the question. Dell Computers, they actually announced just a couple hours ago that they are going to, by 2024, so much faster than I would have expected, they are going to attempt to move all of their chip consumption out of China. And then I believe the stat was by 2025, they hope to have none of it even produced from China. So, you know, these things are real. We talk about them oftentimes in anecdotes, but you know, occasionally, like earlier today, we get actual headlines of companies truly making an effort to do it, and making an effort to do it in a fairly fast way.
Yeah.
Now, flipping over to the metal side of things, nickel, unfortunately, I wish I had better news here, but it continues to do what nickel does, which is trade with very thin volumes and trade very, very erratically. For now, the price of nickel is above all three of its key moving averages, the 50-day, the 100-day, and the 200-day moving averages, which from a momentum standpoint, that would be bullish. That being said, the fundamentals and the trading on a daily basis is extremely erratic, and you almost can't use your normal rules to gauge what's going on in this space. To put it into context, if we go all the way back to the beginning of November, prices on nickel were sub $10 a pound. And at one point in mid-December, they went all the way to just over $15 a pound. So in about a month and a half, you had a 50% move in the price of nickel on really no news. And from what I understand, very little trading volume. So, you know, it stinks because this is a relatively niche market that is ultimately having knock-on implications to a multi-billion-dollar industry, which is stainless steel and electric vehicle batteries. So something probably needs to change, and I've got a little bit of an update here in a couple slides. But as we sit here right now, I still stand by the argument that fundamentally prices are still arguably too high, but it's really just kind of a game right now where traders seem to be pushing things around. And, you know, just in the last 2-3 days, we had prices up above $14.50 just on the first or second of the year. And since then, it's already dropped down to about 12.5. So that just gives you a sense of the extreme volatility that's taking place on very little news, very little volume, which it stinks to say, but that's what we have to deal with. And this gives you a visualization of that departure of volumes that's really left this market. So for those who are new to the show, what this is showing is nickel open interest, which is another way of saying the volume traded on the London Metal Exchange nickel contract. Ever since the short squeeze that occurred back in March of last year, which put a lot of people at risk and made a lot of people very upset, 38% of the market has stopped trading it. They've just gone to the sidelines. So that's what allows smaller volumes to kind of push prices around in a big way. Now, with that being said, this is an update as of yesterday and today, the first of which is the headline and kind of the image on the left, which is a company called Global Commodities Holdings. We've hinted at this potential, but Global Commodity Holdings, which they're a trading entity or a platform entity within Europe. They are looking to begin in, I believe it's in the month of March, a physical nickel trading platform. So it's not yet a futures contract. It's not yet something that we are going to be able to trade, but they're in the early stages of setting something up that will be a different venue to actually transact in nickel products. I don't know exactly what the details are going to look like, but it does feel as though they're trying to take on this opportunity that they see open at the LME. What gives me that idea? Well, one of the people who's running this company, Global Commodities Holdings, it's the ex-CEO of the London Metal Exchange, Martin Abbott. So he probably knows some of the inner workings of what's been going on, where the weaknesses are at the London Metal Exchange, and where potentially they might be able to fit in. So more to come on that story, but early days. And then perhaps not unrelated, the LME chairman just earlier this morning, Huey Evans, he announced that he was going to step down and resign from the London Metal Exchange, and they're pointing to blaming the nickel market for that issue. So, this is something that is going to take some time, and I hate that every month I have to report on this idea that it's kind of a broken market, but these things will take time, and hopefully all of these things work towards progressing to a better solution for market making, price discovery, things like that within this space.
And Nick, I've been fascinated with this story ever since it happened in March, and it's interesting to see now that there could be some competition. And I think the thing that I take from the last few months is you're perhaps the audience knows this, but just now knowing like the class 1 versus the class 2 type nickel, right? And like class 1 is traded on the LME, but class 2 is not. Is that correct?
Yeah, that's exactly right. So class 1 nickel, which is going to be the refined market, basically 99.9% purity. That is the only allowable metal that's able to go onto the exchange system and the warehouse system of the LME. Unfortunately, with the evolution of different types of mining, different types of nickel processing, a much larger percent of the world's nickel that goes into stainless steel, and even a lot of the nickel that goes into electric vehicle batteries is not refined nickel to start with. So what maybe historically represented the nickel market on a global basis is no longer really the case. And that dichotomy is what's kind of caused this issue. Is the LME is what it represents almost is not even the market fundamentals anymore.
Could you essentially see class 2 being traded on this Global Commodities Holdings or
you could. I mean, there's a potential they have, some sort of discount mechanism where, if you deliver refined nickel onto the platform, it would trade at X. If you deliver in some lesser grade, nickel pig iron, nickel matte, something like that, maybe it trades at X less a percentage, something like that. I could certainly see that taking place. Or it could be a totally separate contract and they just allow you to trade refined, or you can trade nickel pig iron, and they would just all go at different prices. They would represent their own markets. I think either one of those would be a much healthier step towards approaching these evolving dynamics in the nickel market.
Yeah, very interesting. Yeah.
Now, last but not least, going to touch on the aluminum side of things, which is going the opposite direction of what nickel's been doing. We were seeing a little bit of optimism over the last couple of months. You can see momentum was beginning to build in the London Metal Exchange aluminum ingot price, but we've since dropped below a couple of those moving averages. So for now, it's kind of wait and see. We're back down near $1 on the ingot price. To the extent, I think a lot of traders are really watching what's going to happen with China. If China comes back and they say, at Chinese New Year, we're going to open the spigot, we're going to put loans into the system, I would expect not just aluminum, but really all metals to react positively to that. It does remain the case that I would argue there is a floor in how low we can go on aluminum ingot prices, given what we know today, given where energy prices are, where certain aluminum smelters are not able to make money as you start digging below $1 per pound, and certainly as you get down into like 90 cents per pound. We've talked about that in prior couple of Joes, but I think a lot of traders are just kind of doing a wait and see on the LME aluminum ingot side of things. Now, on the opposite side, Midwest premiums are going the exact opposite direction. We talked a little bit about the idea last month that premiums were beginning to stabilize right around 20 cents per pound. Well, as you can see in the white line here, it may not look like a whole lot, but that's about a 20+% move on a month-over-month basis, and it's come really in the last 2-3 days. Now, a couple things are happening, and one of them may sound a little similar to nickel. But one of them is also related to the fact that as we overlay the premiums market to the flatbed truck demand index, so this is put out by truckstop.com, you can see that generally the inflection points tend to correlate with this truck stop flatbed demand index. And that demand index has actually moved marginally higher. That could be aiding part of that improvement. Now, I've talked to some industry participants who do a lot of trading and a lot of market making in Midwest premiums. And some of the dialogue I've gotten is that, unfortunately, similar to nickel, there are very few players who make markets and trade in premiums. It's a very niche market. It's way more niche than even nickel. And unfortunately, it sounds like there's a little bit of a phenomenon whereby those who are setting the prices and reporting it to the index, which would be similar to like the CRU, in this case, it's called Platts. Those individuals who are making markets are basically just saying, we know there are so few players, we can kind of set the price wherever we want. So we are beginning to see this move higher. I would assume it probably fits that market maker's book for whatever reason to set those prices higher. But as we look at futures markets, and we haven't done this in a while on premiums, the blue line is going to be as of a month ago, the green line is a week ago, and the orange line is as of today. Just gives you a sense of how dramatic the futures and the spot prices are reacting to these resets in the premium market. So as we sit here today, the market's basically saying we expect premiums to be somewhere in the mid to high 20-cent range, which is, again, 20 to 30% above where we would have been just a week or two ago. So while we are seeing a little bit of a downward pressure on the ingot side for LME, we are seeing an offset in that, and maybe even more than an offset on the premium side of things. So those two in combination are basically keeping aluminum prices stable on the ingot side.
So Nate, to confirm, does the blue line, are all three lines futures and
They
what
are.
it was projected?
Yep,
The 5th, the 29th. Okay, so on December 5th, the futures line projected will call it a little under 24 cents. So now it's reached about 25. Okay, gotcha.
Yeah, so we basically moved up. The expectations moved up by about 3 or 4 cents.
Yep. Okay. Thank you.
And I said last but not least on aluminum, but I actually have a lot to talk about on carbon. Interestingly enough, as China has begun to move away from its zero COVID policies, you can see down in that orange line, Chinese prices, which I would say kind of represents the global floor of where steel prices ultimately are, has moved a fair amount higher by about 10% in the last couple of weeks. Taking note of that, we've also had US prices moving higher by, I'd say $50 to $75. European prices have moved higher by about the same. All of them are staying relatively converged in terms of their relative price structure. It looks a whole lot more like pre-COVID type phenomenons where the US just tends to trade at a little bit of a premium to these other regions, but the spreads are tight and all of them in concert are going a little bit higher right now. For now, I don't expect this to take off and go back to $2,000, but certainly it does appear as though for now the trough is in. We are bottoming. It looks like we're seeing a little bit of upside in the coming months, and the futures market corroborates that. Both the futures market on the hot roll side, which is shown in the white, as well as the implied cost of making steel using busheling scrap futures, which is shown in yellow. Basically what that's doing is it's taking the busheling scrap futures market, it's adding on $300 to kind of give an implied fair value of where steel prices should be. They're pretty much in lockstep with one another in terms of where the fair value sits versus where the current steel futures market is. That being said, it is worth noting that some of these prices, as we look out into May, June, July, those are in excess of $800 a ton, which is more than $100 above where we currently sit. So that's the market's way of saying the expectation is that CRU and steel prices generally are going to continue higher as we roll through the months ahead. And the early look for January scrap prices, as we sit here today, for the key indices is up $30 per ton for most of the scrap grades. So it looks like a similar phenomenon is happening on the raw material side as well. Now with China reopening, although I do think it's going to come in kind of fits and starts and they're going to have their own headaches to deal with, the commodities and the raw ingredients that are linked to China and linked to steel are taking notice. And you can see that here, we've got the white line, which is going to be Chinese iron ore. It's moved higher by about, let's call it 25, 30% since beginning of November. And then you've got Australian coking coal, which maybe is a little more muted here. It's obviously come off extremely high levels, but coking coal markets have started to respond as well, and that's shown on the left axis in the blue line. One other notable thing that's happened is with China reopening and with China kind of, redetermining who they want to be friends with and allies with and buy from, they did announce that they are contemplating lifting a ban that they had put in place on Australian coal. So ultimately that makes Australian coal more attractive. You can see that in the price action over the last couple of days, fairly notable. My guess would be that that probably continues as China gets back to a more normalized demand schedule. Now, on the production side for U.S. mills, this trend it continues to get worse. I don't know, for lack of a better word. As prices have gone down and down and down on steel, steel mills have reacted domestically by reining in production capacity utilization, which for those who are new, that is taking the production that's totally available for the United States and then looking at what assets are actually producing, what tonnages are actually getting produced, and then creating a percentage on that. And you can see that for the last couple months, maybe the last 5 or 6 months, capacity utilization has moved pretty rapidly lower. We're now sitting at 71.8%, which is really the lowest we've seen since back when steel prices were down around $400 or $500 back in 2020. So this is certainly the steel mill's effort of trying to balance supply demand conditions, ensure that prices stabilize, maybe see a little bit of upside. And worth noting, I don't have a chart for it, but I saw a headline earlier this week that Turkish production utilization is down at 50%, which you can see here in this chart. U.S. production utilization never even got down to 50% during the COVID times. Those are pretty staggeringly low production numbers. So, there are definitely some regions of the world that are trying to fix the supply side of the equation to make sure that prices bottom out and maybe trough and turn a little bit higher. And then I think this is the last slide. On the plate side of things, we're beginning to see, or continuing to see, the convergence of what we've been talking about for the last couple of months, which is steel plate prices are coming fairly rapidly lower, while hot roll prices, sheet prices are beginning to turn a little bit higher. Those two things in combination are basically closing that gap or that spread between those two products. My gut still says this trend continues. And one of the main reasons for that is because earlier this week, Brandenburg, which is a steel mill that's been commissioned and is beginning to produce, has actually started to produce its first plates of steel here this week. So that's just going to add more supply to the equation, better balance supply demand conditions, and arguably bring spreads between sheet and plate back more into line. So with that is all we've got for this little rendition. I've got one last little teaser on the back end post Q&A, but we'll go ahead and answer a couple questions if there are any.
Absolutely. Yeah, great stuff. A few questions coming in here, particularly on that last about the utilization rate. That's a fascinating chart because, like you pointed out, right? I mean, if you look, we haven't been below. I mean, that was around the COVID era, right, where that big dip is in the middle, and we haven't been this far down. And now you mentioned the Turkey utilization, the 50% range. The question is, would this point to U.S. scrap price decreasing as scrap piles up on the coast, meaning like Turkey's a big buyer of U.S. scrap?
Yeah, it certainly could. I mean, it's certainly worth noting the fact that, Turkey is kind of the global hub of scrap trading. And with Turkey operating at 50% capacity, that could weigh on scrap's ability to really rally a whole lot. Similarly, the domestic side of the equation is kind of the same, that if fewer and fewer domestic producers, particularly electric arc furnaces, are turning off production or rationing production, then yeah, that would demand less scrap. Now, offsetting that to a degree, you could argue China coming back to the table maybe adds a little bit of an influx on the demand side to the upside. But yeah, I would say that generally would be true. The one caveat to that answer would be if it's blast furnaces, so U.S. Steel, Cliffs, some of those entities, if it's their assets that are getting turned off, that may on a net basis have no impact whatsoever on scrap prices really, or scrap demand really.
And I guess circling back to this, the U.S. rates, how low could they essentially go without? I mean, of course they can go as low, right, as 50% as we saw here, but like after a while, you've got to make some back that up a bit, right? Say like, we can only go this far down without,
Yeah. I mean, I don't have a perfect answer on that, but there certainly is a balancing act that takes place at the mill level. I'm sure they have these conversations all the time, which is balancing volume versus profitability. That's really the equation. Is you can put out 1 ton of steel and you can make $1 million on it, or you could put out 1 million tons of steel and maybe you make $50 on it.
Mhm.
Balancing the right answer on that is what they spend their time, doing every single day. So I don't have the perfect answer on that, but certainly, if they're seeing demand fall off, which they did back during the COVID time, demand fell off and they did not know when it was coming back on. They took a very knee-jerk reaction, and probably the right reaction, to shut it down in a big, big way, because only essential demand was actually taking place. We saw the opposite effect of what happened when demand came back much faster, obviously, than supply did. Prices went to $2,000. Those types of things are risks in this equation, that if you over tighten on the supply side, and at the same time, and I would argue this is the case, have imports dropping and dropping and dropping, if we get some surprise demand side to the equation, you could wind up in a spot where there's a little bit of a pinch in getting steel again. I don't think we're there just yet. And certainly there are new production assets coming online in 2023, 2024 on the steel side that should help to temper some of that. But yeah, these are low levels relative to history for sure.
Yeah, interesting. Question here from the audience. What do you hear about the recent announcement from China regarding new export duties? And how do you see this affecting domestic China and basically affecting the Chinese and US market?
Yeah, so the detail is China announced that they were going to increase their export duties from 15% to 30% on aluminum ingot. Sounds like a big change. It's going from 15% to 30%. From what I've read thus far, expectation is it's going to have almost no impact on the market. The reason for that is because, at least up to this point, China is not really a net exporter of aluminum ingot anyways. I kind of read it a little more symbolically of China just seems like they're taking a little more verbal and headline type stance to say, we're playing hardball. We're gonna start to keep things for ourselves. And I think that's probably, in my opinion, worth more than what the actual change in the tariff rate is. That if China's making headlines and saying, nah, we're going to keep more of our stuff here. I mean, imagine if they start doing that with things that they actually do export, like semiconductors, like rare earth metals. It could be a little bit more of a trade strategy than an actual aluminum related story.
Makes sense. Got a question here about the price of hot roll. Hot roll is currently at, remind me again.
We're in like the, let's call it $675, $700 range on spot prices.
Yeah, I don't want you to put on your prediction hat, weather prediction hat, right? But they're asking pricing. Do you think it could go as, I guess, where do you see it going in the first quarter? Higher, lower?
Yeah, I mean, if I'm a betting man, I think the odds of steel prices being higher in Q1 is greater than lower. I think probably even higher odds than it being flat. I think the highest likelihood in my case, in my mind, is that prices are going a bit higher. I don't think prices, and this is Nick Webb's personal opinion, not investment advice, I don't think steel prices are going to $900 to $1,000 on hot roll in the next couple months. But things can change, and I certainly want to be open to those possibilities. But it doesn't look like those types of massive moves are yet in the cards as we sit here today. And the main reason for that is just because you've got a North American economy and a European manufacturing economy. They're both hitting some headwinds that are really kind of purposeful from the Fed.
Yeah. Infrastructure bill is a question from the audience. Do you see the bill keeping plate prices up as money flows into states for these plate intensive projects? We've talked about that in the past.
Definitely provides a little bit of a tailwind. I still think the gap between plate and sheet is too large relative to what fundamentals are of making the product. But yeah, I do think that between that and the Inflation Reduction Act, which maybe I shouldn't even say this, is more stimulative than anything. Those things are probably tailwinds to keeping commodity prices a little more elevated than otherwise.
Without dredging up any bad memories about Ohio State and the recession, do you hear anything more about market data indicating we're any closer?
You just had to bring up Ohio State, didn't you? I actually blacked out in a fit of rage. I missed the second part of the question.
Is there any data? Fair enough. Any data come out that hints that do you believe we'll enter into a recession still, or unsure based on current market data? I guess, has there been any official and closer to any official indication, right? Because if you recall, for the audience, our wager was, Ohio State losing, or official declaring of a recession. Kind of what's the latest there?
Yeah, I will have more on this answer here in just a couple minutes when I give my farewell for the month. But yeah, the short answer, just kind of going through the list, I would say leading economic indicator index, which shortened LEI, which takes a smattering of 10 different indicators. It looks at business cycles. It includes ISM data. Those look like they're signaling recession already. I would say you look at ISM PMIs, whether you're using the Institute of Supply Management or you use market, both of them we showed in the first couple slides, those are weakening, and they're weakening on a global basis. I would say that's signaling recession. Chicago business PMI, we showed that last month, looks like it's signaling recession. And by the way, not all of my answers will be the same. I promise there will be caveats to this. If we look at the yield curve, which is looking at some of the shorter dated interest rates from the government relative to longer dated interest rates, I won't go into detail on what all of the implications are, but those have inverted, and they've been inverted for the last several months. That signals a recession. That being said, I would argue that when we go out to our customer base, I would argue that when you look at the services economy, when you look at the jobs market, those are very much so not flashing recessionary. So yeah, you've got some very conflicting things. Some people are out saying the sky is about to be falling. And then there are other people who are saying, no, this is going to be fine. And a lot of our customers are suggesting that for now. So yeah, I still tend to believe we're in a very softening economy, and it's very purposeful, but we're not seeing it in all of the aspects you would normally see it in, namely jobs, wages, things like that, which are holding up staggeringly well.
So sounds like you got a little teaser for us or something, a little nugget for us to close it out. So I'll leave you with that. There's a few other questions we'll definitely get to those. So as a reminder, Engage January 26th. Please register at Engage. That's ENGAUGE.tv. Got a few notes that it wasn't working, but you gotta add the U in there. And then we will be back for our next Cup of Joe March 2nd, which I believe is the first Thursday of March. So no Cup of Joe in February. We'll have an extended Cup of Joe on January 26th with 3 of our product managers joining the conversation. That should be a really interesting one, along with some economists and a special guest. Before I sign off, any thoughts on who wins the NCAA championship, Nick?
I think Georgia's got it by at least 2 touchdowns.
2 touchdowns. Okay.
Yep.
Yeah.
That's my biased opinion because they beat us.
Yeah.
But it would be really cool to see a new team in the mix, and TC looked quite good in the playoff game.
Agree. Well, then I will leave it, and this recording will be up on our YouTube channel by tomorrow, latest on Monday. And then of course sign up for Engage. Nick, over to you for some closing thoughts.
Yeah, so we'll be back hopefully with many of you here in just a couple of weeks. And what I want to do is slightly change the dynamic of Engage relative to what we do on Cup of Joe, to give a little bit more of a snapshot on, forward-looking thoughts for 2023 and maybe even beyond 2023. So it's a little bit more of a kind of planning type session. And I think in combination with Alan Bolio, Eddie, you're going to get some great insights into where we're seeing things. And hopefully they even conflict, and hopefully we can have a little bit of entertaining discussion around these things. But with that being said, I got a question from a colleague earlier this morning who asked me the question because they came across this bottom left corner piece of research, which is suggesting, and this is from Goldman Sachs, basically their commodities theme for 2023 is that we're in the middle of a commodity super cycle, or perhaps in the early stages of a commodity super cycle. And the colleague reached out and basically, long story short, said, how is this possible? Explain this stance to me. So rather than responding via email, I responded back and said, I don't want to type all this. Let's just talk about it on Cup of Joe and give a little bit of a teaser, and we'll expand on this here in a couple of weeks. But in addition to the Goldman piece, for anybody who's seen the movie The Big Short, there's a character in there who's played by Christian Bale. Christian Bale plays a real person who actually did short the housing market in 2007, 2008. His name's Michael Burry. He was an ex-doctor, turned hedge fund manager. He tweeted this tweet earlier today or yesterday, and I'll just read it real quick. He said, inflation has peaked, but it is not the last peak of this cycle. We are likely to see CPI lower, possibly negative in second half 2023, and the US is in recession by any definition. So that kind of comes back to Mike, your question. His view is that we are already in recession. Now, I would argue against his statement in saying that any definition, because jobs are still holding up quite well, services are holding up quite well. His argument is that the Fed will have to cut rates and the government will have to stimulate the economy again. So either printing free money, sending out helicopter money to people, or whatever their new method is. His argument is that things are going to get so soft from a recessionary standpoint, and inflation is going to come down to such an extent that the Fed is going to have no other option than to go back into printing money, inflating the economy, basically circa mid 2020 in trying to jolt things higher. And then he says, and we will have another inflation spike. It's not that hard. Now, that is a possibility. And again, we'll dive into this in a little more detail. But the idea is essentially between what he's saying and what Goldman is saying is we do still have in some commodities, take oil, take maybe all fossil fuels in general, take copper, take aluminum to a degree. We do have situations where we've, as a society and as a global economy, we have underinvested. And underinvestment can be fine as long as the economy is flat to slowing. And I would argue that parts of the economy probably are flat to slowing right now. We showed that in a lot of the manufacturing data. If in the event we get into a situation where we stimulate the economy again and we get another 2020 2.0, there is a realistic scenario that could cause, maybe not in 2023, but maybe in the last couple months of 2023, a scenario that forces the Fed to not just stop hiking interest rates, but actually say we need to prop up the economy, we need to do all it takes. And if that happens, I would argue we probably could see commodities really take off again, because we have not fixed the structural element of the supply side of the equation. We're getting lucky right now because the economy is slowing. But if the demand picture changed for whatever reason, I would say stimulus would do that. That's really the landscape that both Michael Burry and Goldman to a degree are really arguing here, which is we haven't really fixed the longer term issues. And I put this chart here, and I don't want to get too into detail on it because I want to leave some stuff to talk about here in a few weeks. But this is looking at M2 money supply. So this goes back to kind of Econ 101. Basically the amount of money that's going into the system. There's no doubt about it. Back in 2020, the government put a lot of money into the system by way of PPP, lowering interest rates, expanding the balance sheet, very well known. Now, if you overlay the money supply that was put into the economy and lag it by 16 months, and then overlay the CPI, which is inflation, you get some pretty compelling correlations between these two charts, which is basically saying the more money you put into an economy, the higher prices are going to go. And the reverse is also true, or maybe true. And if we use this same logic and we look at where money supply has gone over the last 24 months, well, money supply has actually gone to 0%. And if we continue this logic of saying this is a forecast into where inflation goes, then maybe what Michael Burry is saying is accurate, which is maybe just on its own regard, because we've taken money out of the system, we're going to see inflation come down and down and down. The concern of some market participants is if inflation is coming down and down and down, how do we get it to stop? Is it possible they could overshoot to the downside and cause a hard landing? And if they do that, there's going to have to be stimulus. And if there's stimulus, that's when you could see this commodity super cycle. So I know I got very wordy on this, but I wanted to at least set that landscape, because this could be something that we see maybe in second half of 2023, maybe first half of 2024, where if things continue to soften at the rate they are, we may have to see a government step in and actually intervene with some stimulative measures. And things could get very interesting in that situation.
Very fascinating and great tee up for discussion on January 26th.
Excellent.
More to come.
Thank you, everyone.
Have a great afternoon.